Hello, everyone. You are watching our free webinar, Landlord Due Diligence in a Coronavirus World. My name is Howard Kline. I've been a licensed California attorney over 4 decades. It's been more than that, but I'm not going to really tell everybody. This webinar has been very near and dear to my heart because I've been in a position where I've had to look at properties that have failed, and as a result, I look at the leases. So I've lived through 5 recessions. During the Great Recession, I was fortunate to represent one of the largest special servicers in the United States, handling, among other things, post-foreclosure commercial rent collections. In all collection actions, my initial responsibility was to determine the collectability of past due rents. Keep in mind, I didn't pay attention much to whether or not we'd obtain a judgment. It was the collectability that was important. That initial analysis included a review of leases and pre-lease due diligence conducted by former property owners. If it's a collection lawsuit, you want to know if you're going to collect. It shocked me how little due diligence was done by landlords and the total lack of follow-up on the information that they received. In this webinar, we're going to take a deep dive into the landlord's best practices and proper due diligence to ensure that the landlord will collect rents that it contracted for. This webinar will arm commercial landlords with the initial and practical strategies to maximize the collection of rents. The information we provide will also benefit tenants in order to allow them to anticipate and streamline the lease and rent concession process, particularly during the COVID pandemic. One additional thing I should mention. Today's a busy day for me. I'm appearing at 1:30 p.m. Pacific Standard Time on an episode of Deep Dish streaming on Facebook by Rin Longmaid. How to get that straight. Rin is a business broker in Northern California who focuses on commercial restaurant sales. In this upcoming episode, and it's just by coincidence, I will be talking about the effect of COVID on restaurant lease, current and future lease negotiations, and requests for rent relief. The link is provided in the description section on YouTube. Now, let's go to my quick introduction. All right, here we go. We're not giving legal advice. If you need legal advice, please consult your own attorney in the state that either you reside or the property is located or your business is located. You, of course, can contact me and I will refer you to someone, or if it involves California property, we'll see if I can help you out. If you have any questions, please put the questions in the comments section, and I see we already have one, Happy New Year, or any questions, comments, please put it in. As a matter of fact, if you would, let everybody know right now where you're watching this from. Finally, please subscribe to my YouTube channel. If you like what you hear or see, click the subscribe button below the video, and I'll play that again, and hit the bell, which will give you all of the information as my new videos come back. So now, let me introduce our panelists. Let's start with Ken Lamy. Ken, as you can see, is in the upper right-hand corner of the screen. Ken is the founder, president, and CEO of the Lamy Group based out of New Orleans, or should I say New Orleans? An international financial management and consulting firm. He is an internationally recognized professional with over 35 years of deep experience in retail real estate. I had to do that, Ken, because that was on your website. Or did I do it deep enough?
That was great.
He is considered a global subject matter expert on retail leases. Oh, I should be looking over here now. I always get that wrong. I need one of those flashing lights for the different cameras, including retail leases, rent, sales analysis, revenue data verification, restaurant operations, consulting, lease language. Is there enough there? Is there anything you don't do, Ken? And let me move on now to Jeffrey Kreshek. Should I call you Jeffrey or Jeff? I can't hear you.
You should call me Jeff.
Oh, okay. Jeff currently serves as the Senior Vice President, West Coast Leasing for the Federal Realty Investment Trust, a S&P 500, that's Standard & Poor's, real estate company founded in 1962. It's a REIT, if you haven't otherwise heard the term. He oversees the day-to-day leasing activities of Federal's West Coast portfolio. Jeff is the junior in this group, I believe, having over 30 years of experience in leasing, entitlement, property, and asset management. Welcome to the show, Jeff.
Thanks for having me.
And then we have Peter Morris. Peter is in the lower right-hand corner of the screen. He has been my co-host on numerous webinars, live streams, and podcasts for over 10 years. It's been that long. He is the founder and CEO. Yeah. Although I kind of lose track on which Friday it is right now. He's the founder and CEO of the Greenstead Group, an international full-service commercial real estate consulting firm. He hails out of Vancouver, Canada, by the way. Peter is a highly credentialed real estate executive with over 40 years of global experience. He is widely recognized as an industry leader, commentator, author, and educator. And I didn't mean to leave educator to the last, but he does a lot of training up in Canada. And then, of course, me. I'm Howard Kline. Of this panel, I am the senior statesman. It seems like lately I have been, although I'm setting up an interview with someone older than me. I've got over 45 years worth of experience as a California licensed attorney and to a great extent involved in commercial real estate. I've represented hundreds of landlords and tenants alike in lease negotiations, evictions, rent collections, and foreclosures. I've served as general counsel for 4 different companies and as a director of real estate for a national educational corporation where, among other duties, I was responsible for identifying campus locations, negotiating the leases, managing the tenant improvements, and the permitting process. So I did, in addition to my legal duties, I was acting as a broker, and at the time I had a broker's license. So now, with all that being said, how much time did I take up? 8 minutes. I got to do that quicker. So let's now start with the webinar. Now, Ken, why don't you explain to us what you mean by due diligence?
Sure. What's really important is that there's financial due diligence and there's operational due diligence. And so we're focusing really involving the financial side of the relationship between the retailer and the landlord. One of the things that I always like to kind of use as a framework is thinking of a bank who's underwriting risk as part of a loan application. And so at the Lamy Group, what we continue to do with our clients is help them evaluate risk. And so that's often done by evaluating and taking a look at financial data. And so I go back and say, well, in my early years in public accounting, many, many decades ago, I spent about a year and a half working with small businesses, retailers, restaurants, service businesses, in putting together SBA loan packages where we had to literally manually, because that was all pre-technology, spreadsheet 10 years of pro forma projections, revenue as well as expenses. In going through that process, you really worked closely with the owner of that business in really developing the assumptions. That's really a key part of it, is in their business model. Is what are the assumptions? Can you defend them? Does it make sense? So we really are focused in the due diligence arena of retail real estate is about the retailer's financial model. And so as an example, we had a case last year where there was a restaurant that worked on approaching a landlord. Our client, the landlord, came to us. They were interested in getting a rent relief situation because they had a few local restaurants and they were having difficulty because of the COVID restrictions. And so our client provided us with a number of financial documents and data elements, and we'll talk about that in a little while, relative to what should you receive from that merchant to evaluate their need. Much of what we're involved with is helping in a rent relief request, the due diligence to prove that there's a financial distress condition. What was learned is, yes, food cost has gone up. We all know that labor costs are skyrocketing with the COVID restrictions and the things that they have to do relative to sanitizing the restaurant. And there was some in-dining, but with the restrictions, takeouts, and delivery. This restaurateur had gone from highly profitable in terms of their gross margins as well as their food cost under control to where everything was totally reset. So what's important to remember is that what was pre-COVID is not now. It will not be that in the future. And so there's 7 kind of things that we look at when we're looking at the data, kind of to lay a framework and a foundation for the discussion that we're going to share with you today.
Ken,
you want to try? Yes.
Can I interrupt you a second? I'd like to ask Jeff a question because and I'm going to bring Jeff in here. Well, maybe I should put all 4 of us. Nope, don't need that. Here we go. It's a problem when trying to do all the technology. Jeff does due diligence in addition to the financial analysis. Jeff, why don't you talk about the kind of due diligence that, in my opinion, raises the bar much higher for the landlord?
Yeah, we do a lot of secondary due diligence. And one thing that's really important, just to hit on Ken's point, is financial due diligence is really important. But remember, that's a snapshot at a moment in time. It's no guarantee that the financials that you see are going to remain consistent. And I think COVID has really shown us that. But the secondary due diligence we do is, we look at their other stores. We meet the owners eyeball to eyeball. We listen to their business plan. Does it make sense to us? How the tenant is going to make money, what their real experience is. Are they a franchisee? If so, what kind of business were they in prior to this? If they're a restaurant, what kind of food do they serve? Who's their customer? Does that look and feel like the same customer that you have at your project? There's a lot of elements to it because you can see the best financials in the world, but if the business model makes no sense, it just means that you have a better chance of collectability, as you mentioned earlier, but it doesn't mean you have a better chance of success. Because at the end of the day, what we're really looking for is not, if we get to the point of collectability is our benchmark, then something's gone wrong. What our real goal is payability. Can you actually pay the rent and operate the premises and operate the business for the amount of term that we've agreed to? So the due diligence on, the operator himself, his experience, the business model, the customer, that's almost, if not more important than the financials. Of course, if somebody shows up with financials that show they have no money, that's probably a bad sign day one. But if they have money with a bad business plan, that's probably just as bad.
Peter, do you have any comments based upon your 40 plus years of experience?
I knew you were going to bring that up, Howard. Actually, jumping on what Jeff said, and I think it's important, and I'm going to throw it back as a question to Jeff, and that is, a lot of leasing people may not be properly equipped in order to evaluate whether or not this business plan makes any sense. So how do you backstop that junior leasing person? Do you call in someone like Ken to help out? Do you have other resources that you go to? And I know you're with a big REIT, but let's call a spade here. Your due diligence is only going to be as good as the person conducting it. So if it's a junior leasing person, what are they going to do?
Well, I mean, that is one of the more interesting challenges is you're your judgment is really your guidepost. It's your own personal experience, your own willingness to dig a little deeper and to look at these facts, the set of facts, a little bit more objectively. And for junior person or somebody just starting on the business, they may not have the experience. There's lots of resources usually within companies. It's not rocket science. You don't have to have an MBA to be able to do this due diligence. It's as simple as saying, well, they sell donuts, and donuts are sold from 6 a.m. to 10 a.m. How many donuts would they need to sell in order to pay the rent at a 10% occupancy cost? And when you do the math and you realize they have to sell like 4 million donuts a month, that's pretty easy to tell. That's not a business plan that's steeped in reality. It's really, for us on our junior people, it's training them to just think logically. It's not overly complicated. You go meet with a business owner and his restaurant is empty at lunchtime. That's a pretty bad sign. It's, the food is terrible, or the customer doesn't feel right, or whatever. There's so many guideposts or so many markers along the way that you can look at. And it's really not hard to teach your junior people, but you have to teach them to think critically. And hopefully they come to you already being able to do that.
That is the key, is critical thinking. And I just also wanted to hear your donut story because I think it's so apt.
We don't do a lot of restaurants right now. There's a slew of them out there that are breakfast only. And you just have to understand that they're missing 2 day parts, or at least 1 day part every single day of the week. So how much do they need in breakfast traffic, and can it work? You just have to stop and do it. It doesn't mean you shouldn't do those deals. It just means you need to understand what the real economics of a tenant lease is going to be, and whether they can afford it. Not what market rent is, but what can the tenant actually pay? Because market rent could really outstrip what a tenant can afford to pay. And there are tenants who are so eager to do a deal that they will pay whatever you ask for. That doesn't mean, we ask a lot of, the main question I ask when we're doing due diligence, 2 questions. Why? Why do we care about this tenant? Why does this tenant care about us? Why does the customer care about them? And what's the likelihood they can actually go forward? And not whether we want to do the deal, but should we do the deal? So if you can't answer the why and the should, we just don't do the deal.
Great. Let's get back to Ken on the financial due diligence. Where were we at?
Yeah, so
Ken? I lost track.
So there's that's okay. So there's really about 7+ things to really look at the data and help you in the evaluation part. One is the trend of their sales pattern historically. If it's a brand new first time in business person, that's again a risk factor you've got to build into the equation. If they have other existing locations, or it could be an existing merchant with you, it's up for renewal, then you want to look at certain sales patterns, monthly history, annual history, year-over-year trends and declines or increases. How do they compare to their peer group within the property or the region? You want to establish, again, certain comparative data relative to the property. How's the property doing? How are they doing? You also want to look at their data for the category. You want to look at how they're doing relative to seasonality. But all of those things would what I'd call exist today, but they're pre-COVID kinds of thinking. As Jeff talked about, how many donuts do you need to sell? Well, how many donuts do you need to sell and you don't have lunch or you don't have dinner? And so it's the number of transactions required with an average ticket to equal a certain amount of revenue to just absorb cost of goods, the cost of food, labor, the cost of occupancy. I mean, it's like the pie is only so large. And if you're a mom and pop retailer, you have a certain size pie based on revenue. You have to slice those 4 or 5 line items that you have to pay every month, doesn't count, or doesn't stop rather. Those fixed kind of expenses are going to be there all the time. What's left? And how much is left to really pay the owner? So you could have someone that's working 80, 90 hours a week and they're making 3%, 4%, 6 or 7% net profit. That's something that has to go into this discussion too with them.
Outstanding. So let's kind of move on to what we're kind of the important stuff right now, or at least the most immediate stuff we're dealing with. Yeah. is this during COVID? There's a lot of discussions here. So, Jeff, there's I think I set out a question for you to ask with regard to existing tenants. Could you ask the question, or do you want me to jump
Yeah,
in?
sorry. Just,
Did I lose you? You lost. I knew you were going to lose.
yeah, I lost my spot here.
Yeah,
And,
you were talking enough as it is.
well, actually, the question you asked, you wanted me to bring up was from a financial perspective. Have we really changed our approach to due diligence in a post-COVID world? And Ken and Peter, you guys might have a take on that, but it's interesting that everything is quantified as pre and post-COVID, but the process really, in my opinion, shouldn't be any different. You should have had that discipline all throughout. The real question to me is, have landlords become more interested in paying attention to financials post-COVID than they were pre-COVID? But Peter and Ken, you might have a take on that.
Go ahead, Peter. I'll follow you.
Okay. Yes. The short answer is yes. But I think what they're looking at, just like lenders look at the worst case scenario because they want to be paid their mortgage and or their loan and everything else like that. I think what we're looking at now from the landlord's perspective, looking at a tenant in the COVID times, is have they recognized that there is a change? Have they made a contingency to be able to understand that what was happening pre-COVID, those numbers need to be adjusted a little bit? As Ken had mentioned, the costs for operating are different than they were before. The bottom line is different than before. How are they going to manage that? And is their timeline, to Jeff's point earlier about, do they really understand the business? If they're saying, oh, you know what, we're going to be snapped back right after everybody's been inoculated or vaccinated, and everything's going to be rosy come September. Yeah, I don't think so. So I think that there's that focus on the financials, but more importantly, the management of those financials is what I would be looking at.
Yeah, I would agree, Peter, as well. And one of the things that's really the business model for that, whether it's retail, whether it's food, their business model has shifted because they're not with the same traffic patterns. They're not with the same occupancy allowed, just depending on the state of the province. And so what's really important to put this all in perspective is I'll share some information that I came across just recently. There's an estimated that sales fell 19.5% last year as compared to 2019. Now, on average. So any business that has that kind of decline, call it 20%, round it up, there's no way that you can continue paying the percentages, which we always look at. The numbers and volume is one part of this process, but what really tells the story, and this is one takeaway for everyone that's listening, percentages of the financial statement are the critical elements, because those percentages have to be managed more aggressively today than before. And so when you have certain margins that are now shrinking, you don't have, back to that pie that I talked about, so give you a visual, that pie is no longer as big because your revenue is down. We're saying 20% smaller. And then you have certain expenses that are higher percentages, so what's left is much tinier. So it's all about managing this whole financial process of revenue, and then you have outflows of expenses. There's some 300,000 plus restaurants that are sadly gone, and there's more going to fail in the next 6 months. Sadly, that's just the reality of what we're working through. I don't know, Peter, if there's anything, some Canadian data that you might have, but in the U.S., that number, and it may be even higher since I heard that several weeks back. Anything in Canada on restaurant failures that you've seen?
Yeah, the numbers that we're seeing from the Canadian Federation of Independent Business and the Restaurant Association is we're looking at 40% reduction of the total number of restaurants across Canada in total. And just in retail, The Canadian Retail Association is anticipating 1/3 reduction of the brands that you see. Now, that may be that some stores fail, other stores will be bought up and the brands absorbed into another brand, because we are seeing, interestingly enough, in Canada as well as in the United States, we are seeing a flurry of mergers and acquisitions going on, where people are taking this as an opportunity to buy out their competitors dirt cheap and solidify their bottom line. And Ken, I have to say this, you said what I was trying to say far more eloquently. And that's what I meant about managing the numbers and managing the financials and managing the situation, knowing what those percentages are and how to deal with those drastically changed numbers.
Yeah, but Ken, one point I'd like to make that I think is important to keep in mind relative to COVID's impact on retail, and trust me, I make no light of any situation where a business is closed and somebody has lost their livelihood or their life's work. But you can't make the argument in the United States that we weren't grossly over retailed, especially if you look at, and I'm not picking on any category, but you look at franchise concepts where franchisors said, okay, you're buying a territory and you need to open 5 locations within 2 years or you lose your franchise rights. And so the franchisee would open 5 locations, spread themselves very thin. The locations probably, weren't extremely profitable. So their margin of error was very, very tight. So it's not hard to see one little blip and they get wiped out. And again, I'm not making light of that, but in a lot of respects, this COVID is really sort of accelerating what was happening in the retail headlines to start with. And quite frankly, is showing just how dangerous not doing your due diligence up front is, or being over anxious to do a deal or not paying attention to the fundamentals, whether you're a tenant or a landlord. There's a fair amount of those numbers of businesses that are going out that were thinly capitalized, probably overextended, probably had some locations they shouldn't have done, or that were never going to be profitable. And COVID just exposed that as a problem. So again, it's not to say that COVID, that somebody lost their business, it was their fault in any respect. I mean, what's happened is just unbelievably horrible for everybody, but it's not hard to see how some of these brands couldn't survive the slightest blip.
Yeah, Jeff, you couldn't be more on point. What I've said for many years is that not only is the U.S. over retailed, but we're really under demolished. We have to right size it's downsizing and right sizing both in the total GLA of retail, but going a step further is right sizing the size of the square footage of a store, because it's great to expand and get bigger and bigger and bigger, but that also creates this fixed expense of occupancy cost that's unsustainable. COVID has magnified and accelerated what was going to happen 5 or 7 years. It's happening in probably 1 to 3. So we're seeing this acceleration that also creates financial stress, but it also says if you're not going to be willing to change and get out of a comfort zone and pull the trigger and take action, you're going to die, sadly, a financial death of your business because you haven't been able to pivot and make those adjustments, reinventing yourself. As I said earlier, what the business was and the market was before the pandemic, it's not the same now, and it's not going to be the same later.
Ken, I know that you're going to be getting to this, but Rudy Million asks a question, so this is a good segue to allow us to get into it. Can you see the question? Ken and Jeff, I have a client. This is what Rudy says. He has a client who recently received a request for rent relief from 2 mom-and-pop tenants. What are the key metrics the landlord should review before granting rent concessions?
Yeah, that's a great question, and I would say that we really want to look at, and I'll move to really the kinds of financial data that should be submitted by the retailer when they're asking for rent relief, and that's really is bringing forward the transparency that allows the due diligence of the financials to be done and the verification, but also it's to tell the story because it's about proving the distress. And so what should really be looked at when it comes to that would be the financial data would be including things like POS data, cash register tapes, bank statements, including the deposit slips, sales journals and cash receipts journals, general ledgers, inventory records, depending on the kind of business, inventory levels and records history historically is very, very helpful. Financial statements, and again, not just the numbers, but the percentages, as we touched on a moment ago. Sales tax reports, just to compare what's being reported to the governmental authorities as to taxable transactions. If it's a mom and pop independent, then federal tax returns are helpful as well. And then there's some other things that the retailer possibly would develop to simply tell the story. It could be that they could show historical positive growth in revenue in managing their expenses very, very well, but all of a sudden, whether it's a restaurant or a non-food operator, all of a sudden now they're at 50% capacity or 25% capacity because of the government restrictions. Our revenue is down. We've seen numbers, we talked about the restaurant business being down 20%. We've seen some retailers be down 50 to 60% year over year. And so you're really looking for the kind of financial strength that says, hey, I'm in difficult times, but with some adjustment on the rent side, I can survive, and I'm willing to put some skin in the game. And that's an important part of this too. In the example that I was talking about earlier, that restaurant operator, because of positive growth and expansion of their number of units, their lifestyle evolved as well. Well, guess what? Right now, because of survival, you've got to scale back and shrink some of maybe that personal lifestyle as part of the discussion between yourself and the landlord. And then the landlord needs to look at things like profitability, financial statement ratios that give some measure that say, hey, their liquidity position is not great, but it's okay. What kind of occupancy cost pressures are they under? And if we have time, we'll get into some of those percentages for certain categories, which really is important because each category is not the same. Their gross profit margins are all different. And if you, back to that pie visualization, if you have a gross profit of 50 or 60%, you have more dollars to work with to take care of all the general and administrative expenses that fall below the gross profit number.
Good.
So you've got to look at certain critical pieces.
I would tell you that, especially for the mom and pops, the more data you can get, the better. But oftentimes, you're in a distressed situation where somebody needs help today, and you're asking them for, a ton of information. And what we found is just people emotionally were worn out and just, didn't have it, couldn't pull it together, what have you. What we really need is we need to look at their sales history. We need to look at their current, P&L for the business. If they have multiple locations, we want to look at the P&L for the corporate entity. So if one is down, or are all 5 locations down? But it's not so much what you get, it's what you do with what you get. Once we see that sales are down 20%, and we've seen that literally thousands of times, the question becomes, is this a tenant that we think can come out of this? More importantly, how do they come out of it? Is it, as Peter said, is it snap right out of it the next day, the minute everybody's vaccinated, or is there a ramp up time? You see a year that it's going to take for their business to recover, and then right sizing what we're willing to do. But to Ken's point, the tenant has to have some skin in the game. Very early on in the pandemic, we had tenants just saying, you need to just forgive my rent. You need to abate rent just until this is over. Well, define the word over. And abating rent for a tenant doesn't solve the problem. It just moves the problem from the tenant's ledger to the landlord's ledger. It doesn't mean that it's not a problem. Now I can't pay, if you're a small landlord, now you can't pay your mortgage. Well, if your lender doesn't forgive something, then the ball stops with you. So it was really a matter of there had to be some sort of balance between deferring rent, abating rent, and paying rent. And in deferring rent, recognizing that that's under the assumption that the business will come back. But what we're looking for is, what is their past sales history? What are they doing now? what is their P&L, how much cash do they have to weather the storm, and then right-sizing the whatever agreement you're going to make, right-sizing it to their business so they can survive. But is it a business you think will survive in the first place? Because one thing we've had to do in some circumstances is make the very difficult decision of, this is not a business that's going to survive under any circumstance. So the discussion really should be about, how do we get our space back and get the tenant out from under this burden, as opposed to how do we limp them along only to have them fail in 6 months. And those are
one
tough
of the key Jeff, one key takeaway that you mentioned, which is really critical in this whole equation, is getting sales data, getting sales history. Some landlords in the open air space have had leases not include a reporting requirement, and sometimes it's now you're trying to get data from the retailer who needs help, but you didn't require a fundamental disclosure on a monthly basis of just their sales, which allows you to sort. You see those patterns and those trends long before COVID even hit. They could have been struggling long before, but if you have no insight to their performance because you don't have sales, all of a sudden you're fighting the battle day to day as a property manager, owner, asset manager in the dark, which is, there's no transparency. So that's a critical piece too to this.
100%.
And Ken, not only are you doing it in the dark, you're doing it in arrears. You're looking in the rearview mirror. What you want to be able to look at when doing your due diligence is, and I know we'll get a chance to talk about this if we don't run out of time, is how do you do due diligence on a tenant as you go forward generally? And one of the key aspects of that for a retail landlord is the sales performance of their tenants, so that you have an idea, you can do trend analysis. Really easy with today's software, unlike when Ken Howard and I started in the business and we had to do it all on ledger books. But you can do that now, very easy. And I think that it alerts a problem, and then the manager, the property manager or the asset manager, can be proactive in working with the tenant and say, look, we've got something that's going on here. Let's talk about it. Maybe, it gives them an opportunity to exit gracefully with a conditional surrender agreement if it's going to be terminal. Maybe it's just you make the hard decision, hard stop. There's all kinds of things you can do. But if you don't have that data, and Ken, I know, is a big proponent of always having big data on your properties, you got to have it. And you got to have it up front, not in arrears.
Yeah,
COVID
Peter,
is. Go ahead,
sorry,
Jeff.
Peter, one of the points I was going to bring up is there's two different types of financial due diligence. There's initial due diligence, and then there's interim due diligence. And what I think COVID has really exposed is, when times are good, it's very easy as a landlord to sort of say, well, I looked at enough stuff, or it's a good enough tenant, or I heard of it, let's do a deal, as opposed to really being disciplined, and then of course being proactive. You hit it on the head. It's some of these problems with tenants going into COVID, they were evident way before COVID hit. So you could have seen that some of these tenants were not likely going to survive pre-COVID if you were watching, and if you were diligent, and if you were doing your work. But it was very easy to see how people got a little bit lax on that and didn't see this coming and didn't know they had a problem on the horizon.
I know I've heard it on a number of Howard's other webinars as well. Ken talked about being under demolished and the acceleration, and a number of past webinars I've done with Howard, we keep hearing that theme over and over and over again, that all COVID has done is accelerated the issues that we're all facing.
Yeah. Let me move on. We've got a couple of questions. Excuse me. We have a couple of questions that we can actually address that leads into a question that I have. So, Ken, let me ask you this question. What are you seeing with regard to restaurant rent relief negotiations? Many restaurants or other businesses have moved to an exclusively percentage rent approach or a blended approach during the pandemic. What type of rent concession agreements have you been seeing? And in response to that, or as part of that, let me kind of put you on the screen and let me add a question from Kevin Riley. Kevin asked a question, and he talks about this one little element that I've seen in many of these rent relief negotiations. But why don't you tell us a little bit about what you've seen? And just let me answer this question quickly. Yes, there are many landlords who are willing to negotiate rent relief if the tenant extends the term. But again, in order to do that, you need all of the data that Ken is asking for in order to make that determination, because just extending a lease from 3 years to 5 or 10 years, is just not going to do you any good if the tenant is not going to make it or is not likely to make it. Further, let me add, I probably should be on screen, a lot of the landlords, because of COVID, what they're getting into is shorter term leases, which is exactly contrary to extending the term of the lease. And they're getting into the shorter term leases because they're giving rent relief, or they're reducing the amount of rents that they're requesting in a lease, anticipating that in 2 to 3 years the market will be back and then they can start charging more rent. So, Ken, getting back to the question, what are you seeing, in these rent relief negotiations?
Yeah, we are seeing all of those combinations. Plus, really, I'd say there's an underlying theme, and that is creativity is driving solutions. What has to be focused by both sides is we have a problem, we have an issue, and we need to sometimes bridge the time gap. Sometimes it's the financial gap tied to the occupancy that are allowed in those. Is it indoor dining or inside dining or a combination? What else are they doing to, we asked one time, one thing that we ask often is in this whole experience is, so you've been operating the restaurant for X number of months or years, and you've used this primary menu. Where's your second menu? And that answer is a big thud noise, because most of the time the planning and the contingency planning by the restaurateur, they have a set of assumptions. This is the menu we're going to have, and everything's going to work perfectly. Well, it's never perfect. So have you planned for your second menu in case things don't work, or have you reinvented your menu? And we're seeing that a lot across the country. So we're seeing guaranteed minimum rents be reduced. We're not seeing as often as everyone thought originally. There was some percentage only arrangements for 6 months or even a year to build sort of stability of that operator. If the landlord has a lot of money in TI and build out and tenant allowances, there's a lot of capital that's been committed to that space depending on the size of the restaurant, the type of restaurant. So there's a lot of risk that's in there, not just a failure potentially of the restaurant, but if they go dark, then the landlord has to now refurbish that, and the second and third generation space is not nearly as easy to fill as a first generation space. So we're seeing lots of combinations, but as one client said, we did temporarily went to guarantee minimum rent to a fraction, a percentage, 30-40% of the original, with some deferral, and then that's being made up on the back end, adding to the term. But sometimes they're having to keep guaranteed rents in place because of loan covenants, because you've got to have some predictable rent flow coming in from the restaurants across the property and the portfolios.
Yeah, Eddie Lampert. Hi, Eddie. By the way, I call you Eddie. It says here Edward. You can call me Howie. Just don't call me late to lunch. What kind of base rent, percentage rent offsets are occurring with the lease negotiations? I can tell you, from my perspective, representing both landlords and tenants, I approach it from, if representing the landlord, I want to give away as little as possible, and to the extent that I defer rent, I want it back as quickly as possible. Now, it all depends upon the financials and the abilities of both the tenant and the landlord. So I kind of work from that perspective. When representing tenants, I want as much abatement as I can get. Rarely have I gotten abatement. I think in one instance I've gotten abatement representing a tenant, but I've also gotten pretty substantial deferrals. The problem with deferrals, and you representing a tenant, you need to string it out as far as possible, because at some point the tenant is going to have to pay it back. And then that probably is part of Ken's analysis is, okay, let's say we take $100,000 and we defer it out over 12 months. What is the tenant going to be in the position to pay any of that back? And from my perspective, and Rudy Million asked a question about what kind of language. It depends upon who I represent, but I've got to rely upon the financial people like Ken or people like Jeff to tell me this is what the landlord can afford and this is what the tenant can afford. And if we can't come to an agreement on terms, and as I said, if I'm representing the landlord, I want as much as possible, as quickly as possible. And if I'm representing the tenant, I want to pay as little as possible. And we have entered into a couple of agreements that were percentage rent only. But
let me share.
Yeah, go ahead.
Howard, I was going to say, let me just share some percentages that are targeted rents for different kinds of restaurants, and this may be helpful to those on the webinar. For a sit down full service restaurant, those in terms of what should the rent calculate out to when it comes to a percentage of revenue would be somewhere between 8 to 12%, based on, again, the margins that they have with liquor. If it's specialty food, it could be 12 to 15%. If it is a fast food, 15 to 17%. So not all food operators are the same because they all have different experiences with gross profits and their margins. So again, back to the takeaway that we said earlier, they have a certain size pie, their food costs are certain percentages, that leaves a certain percentage for all other expenses, labor, general administrative, occupancy costs, etc. So those are just some guidelines on what we're seeing. And in some cases, the gross deals that are percentage only for this short time. Again, you've got to think of this as a landlord and a retailer or restaurateur, short term, intermediate, and long term. So that could be 6 months, 12 months, 18 months. I think we're closer to the end of this pandemic condition, but I think we have got to think strategically in those terms.
Ken, I have a comment, Howard, that I'd like to make, but I also have a question for Ken. On that percentage on fast food, I'm assuming that would include fast food with a drive-through service as compared to a fast food in a food court in an enclosed shopping center that has no traffic.
That's correct, yes.
Okay, so we have to slice and dice it even further and understand the asset that we're dealing with. But those are great benchmarks. To answer from my perspective, because I've done dozens of rent relief on behalf of one of my clients, on the tenant side of things, what we're doing is Ken said earlier, everyone's getting creative. And at the very beginning of COVID, we'd see people saying, oh yeah, we'll defer 3 months worth of rent and then you pay it back over the next 3 months. To Howard's point, how are you going to pay double the rent if you can't pay the rent now? So what we're seeing and what I've been able to negotiate is a percentage of sales based upon the benchmarks that Ken's noted. And that becomes a deferral with added term equal to the amount of the delta between the percentage rent paid and the contractual rent, to add a little bit of term on there. Bearing in mind, of course, that I'm dealing with tenants that I anticipate will be around for a long time. In some cases, we've been able to negotiate a reduction in the base rent equal to the permitted occupancy by the government. So we've done that. If the permitted occupancy is 25%, and again, these are for businesses that are directly reliant upon throughput of clients. So I'm thinking personal services like barbers and hair salons and things of that nature. If they're at 25% capacity, the number of chairs that they're able to occupy goes down accordingly. So again, we're seeing a lot more creativity. I'm glad to see that landlords, when I'm dealing with them on a tenant side, are looking at being reasonable and saying, okay, yeah, to Ken's point, we have the short, medium, and long term. What are we going to be doing?
But there's two important points. There's really two important points that come out of this. One is this whole conversation about percentage rent for a restaurant really goes back to the point of the secondary due diligence. You better know who you've done business with, because the problem could be a matter of they're just not able to pivot during a difficult time. They don't have the creativity, they don't have the bandwidth and the wherewithal to actually work in a COVID era. And we've seen some of our restaurants doing 120% of pre-COVID numbers because they pivoted very quickly and very intelligently. So knowing who you're doing business with, knowing if they have that second menu, knowing if they're a good operator, if you're going to go to percentage rent, that better be the case. One thing I think is really important that gets lost in all this conversation is the tenant comes to you for rent relief because they've got a specific problem. What about the landlord's problem? So forget the lender for a second. There's lots of creative solutions here. One thing I would suggest is, at a minimum, you're getting paid your triple nets because, for instance, I still have to insure the property and pay my taxes even though you're not paying your rent. So there should be something, some cost covered. But more importantly, the unintended consequence of this for a lot of landlords is going to be co-tenancy. So if we're abating or deferring any rent, that's your tenant's problem that they need to solve. But the problem the landlord needs to solve tends to be a much longer horizon. So if we're abating or deferring or coming up with some agreement to work with 3 or 4 months worth of rent, it's not unreasonable for us to turn around and ask for 12 months worth of co-tolling. Because the last thing we want to do is we want to help it. The last thing we want to be in a position of is we've helped a tenant through their issue for 3 months, 6 months, whatever their time period is. We get through that. I've lost a few tenants. I'm in co-tenancy violation. And now the tenant can avail themselves of percentage rent for 12 months or alternative rent for 12 months while I solve my problem. And the landlord's problem is inherently a longer timeline to solve. So I don't want to get lost in this, that it's got to be a two-way street. Any tenant or landlord that's coming at this from the perspective of it's a one-sided negotiation that only needs to solve one part of the equation, I think is short-sighted. And what we find is the most successful negotiations are the ones where everybody just listens to what the other person's issue is and tries to find a solution that accommodates both.
I call it the shared pain.
Yes.
And that's very much so. Really, nobody is at fault with this. So I have mixed emotions when I'm representing a tenant. I'm very empathetic to the plight of the landlord. And even when you're talking about mortgage deferral and forbearance, ultimately somebody's got to pay for all of this.
Yeah.
And it's right. And I think Peter and I, one of our earliest webinars, we talked about trying to spread the pain out to as many people as possible for as long as possible, which is the only way that I thought that we were going to get through this with the least amount of tragedy, economic tragedy.
A little bit of pain for everybody. And the more people that you can share that out over with, the higher likelihood that more people are going to come out the back end.
Yeah, I think Jeff made some critical points about co-tenancy, and I think this really is the foundation of when you're going to do some rent relief aspect, you've reopened the document. The lease agreement is now open for revisiting lots of components that were trade-offs during the deal making. But one thing that is, I think, a go forward was not just get sales reports, But every 6 months, include in this whole renegotiating of this document, getting financial statements from the retailer that gives you financial conditions and profitability measurements, because it's all about what I call the 3 M's of this business, and that is monitor, measure, and manage. You've got to monitor what's going on. You've got to measure it, as Jeff talked about, the interim due diligence, and then you've got to manage, because risk doesn't change and it doesn't go away. So reopening that lease document when you're trying to accommodate to help a retailer survive, but you absolutely have to protect the landlord obligations. So triple nets and all those reimbursable expenses has to be covered in this whole equation. That's where that creativity and solution-driven discussion takes place.
Yeah, Ken, that is so much on point. And I just, before I get to that comment, I want to mention to Jeff, the co-tenancy issue is really a huge issue. And it's a big problem, and it has to be tackled for a lot of landlords, particularly those like Federal Realty. But when I'm asked to look into a lease, whether it be on the landlord or tenant's behalf, I got to go into the lease. I have to review the lease just like I would as if this was a brand new lease. And my process is read it once, take notes. Read it twice, take notes again. And wherever I fell asleep, mark it. So I can go back and then read it 3 times so that I can then figure out. And then, Ken, I really need to go to someone like you who's got the financial wherewithal. I'll cover the legal stuff so that someone I'm trying to think who it was. Oh, Rudy. Rudy asked the question, what kind of lease language? The lease language could be almost anything depending upon what the financial position is of the landlord and tenant. And from my perspective, whoever I'm representing, try to get the best that I can. I'm repeating myself, but that's the way it's been. I do have another question here from Eddie Lampert, and I'm not sure I understand. What about TI amortizations? Does anybody, Eddie, you might want to explain that in the...
I'll take a stab at it.
Okay.
When I'm doing deals for the landlord, I build back in the TI into the base rent. And when I do a deferral or an abatement, obviously I'm getting a double whammy, not only on the base rent, but also on the recapture. As Ken said before, you have to look at the sunk capital costs into these deals. And so you have to bear in mind, and I think that Jeff said something as well that was really important with respect to co-tenancy. You can't look at the deal in isolation. You can't look at the tenant's situation in isolation. You have to look at it against all aspects of the lease, all aspects of the financials that were looked at, and all aspects of the property as a whole. I hate to say it, but I just did a deal with a landlord working for the tenant whereby there was a TI loan repayment built into the base rent, and they gave away that, so they got that double hit, base rent, and also they weren't getting that loan repayment as part of that. So this person obviously didn't look at the entirety of the deal, and I think that that's important to be able to continue to look at that.
Yeah, good point. Good point. So let's move on into some of these ongoing operation things that we need to deal with. What about percentage rent? I'm going to ask you this, Ken. What about percentage rent for like an office or industrial tenant where we don't typically see percentage rent? Is there any viability to that during COVID?
No. There's
okay. I'm going to take you off.
It doesn't fit that business model. It doesn't fit that activity. Many times, again, if it's office, that's pretty straightforward. If it's an industrial, again, it's a ground lease or it's some long-term term lease that is not involving really any kind of a. Remember, percentage rent is a revenue share model that is a hedge against inflation, which has been really a non-issue for decades. However, there's a lot of discussion now with what has happened over the last year and what's continuing in this year with a lot of the economic stimulus from the federal government that inflation is likely to return. In what form, we don't know. It could be on asset appreciation, or it could be at the consumer level with pricing. So we'll see what happens. But one of the things that's, I think, really important as we move into percentage rent, and it's all about, again, get sales reports from the retailer on an ongoing basis from day one. But also, it's trust that relationship, but verify. Ronald Reagan 40 years ago used the term or the statement, trust but verify. And that's something that we embrace and I talk about on a continuous basis because the data submitted by the retailer still needs to be verified. That's a different form of due diligence, but it's all tied to percentage rent. And furthermore, what's important is think of lease administration is really where the somewhat due diligence occurs on an ongoing basis. You have lease abstracts that someone created and established early on when that lease was first executed. When was the last time someone took a fresh look, as you said, Howard, read it 3 times, the lease document, and really updated those abstracts? And we're seeing and finding for many clients that some of those abstracts weren't capturing all the elements of what in fact are reimbursable, billable values. So this is about not just due diligence with the retailers that are operating, but also the legal documents that need to drive net operating income to create value.
Well, Ken, to your point, you made the comment earlier that when you start getting into a rent relief discussion, the document itself has to be is fair game to be reopened. There's another aspect of this other than co-tenancy, which is restrictions on uses, restrictions on development rights, things of that nature. That we're really stepping back and looking at these things because the document might have been done. And I'll use sort of an absurd example, but the document might have been done 20 years ago. And at that point, it would have prohibited, for instance, marijuana, right? Mm-hmm. Not to say that you're going to put that in your project, but it has some uses in it that are prohibited. Medical is probably the best example where you have retail that said no medical uses in the center. And they were thinking 20 years ago about your traditional dental office or doctor's office. And today there's so many brands that are kind of crossing over between retail and medical that easily could go into a retail center, and you don't have that flexibility because it's not just about co-tenancy. Part of this is we find that right now the mantra we have in our office is remain calm and stick to the plan, but you better have a plan. And so what we're finding is part of that plan has to be, what am I going to do to continue to be relevant with the center? How am I going to evolve? It's a little bit unrealistic to simply look at the retailer and say, are they capable of evolving? It's the tenant should be looking at the landlord of, are they capable of evolving? And I think important to this conversation is when a tenant goes in for rent relief, they better have a pretty good understanding and have done some due diligence of their own on the landlord. Is the landlord financially capable of meeting its obligations? Is this the right center? Are they going to pivot? Are they going to keep this center occupied? But when we're a landlord talking to a tenant, it's, do you have prohibitions that keep me from solving the problem or evolving the project for the next 20 years? And if so, that's got to be on the table as well.
So
yeah, absolutely.
This pretty much requires you. So if you're in a fairly good sized center that might have co-tenancy and other provisions that you're referring to, anytime a tenant goes to you to ask for rent relief and renegotiation, you have to read all of the leases.
Yes.
Or you have to read all of it, which is in answer to Kevin. And yes, Kevin, I assumed it was a joke when you kind of criticized me for falling asleep while reading a lease, but that's true. Yeah, anybody who has to read a 60 or 90 page lease is going to fall asleep somewhere in the middle. But the point is, this takes a lot of work to do this correctly. And if you do it from the landlord's perspective, you got to know all of those leases. You got to know what's going on. And I don't know that a lease summary will do that for you. These terms are often not included in the summaries.
Well, I'll jump
Well-
on there and say two things if I could. One is, one of the first things I'd be taking out of a shopping center lease is the descriptor of the landlord will operate a first-class shopping center. We'll start with that. And, because that's changing. But the other thing is, and I agree with Jeff, I agree with Ken, and I agree with you, Howard, but I'm going to take it one step further. Whoever is discussing the whole concept of rent relief has to look at all the relief that is done in the property, but more importantly, has to look at the strategic plan for that property 2, 3, 4, 5 years out. Because if you're opening up the lease, you might want a demolition clause or a relocation clause, and you're going to have to know why. If you if you are not thinking 3 years down the road that you're going to redevelop it, as we've all agreed, we're under demolished in both Canada and the United States when it comes to retail property. What are you going to do with it? We're going to repurpose it. Well, how are we going to do that? Are we locked into leases that don't allow us to do that? And so you have to have that strategic look a few years down the road. You can't work in isolation. That's the one takeaway that I have from this whole discussion is you have to look at it holistically and you have to look at it strategically at a micro and a macro level.
Critical thinking and having enough data in order to be able to think critically. I mean, that's really what it's. I tell people now that when I started practicing law, it was so easy. A case would have one manila folder. I put all of the pleadings on one side and communications on the other side of the folder. Now it's terabytes worth of data. And unfortunately, after 45 years, there's so much for me to think about. Sometimes it's a little mind-boggling. So
Howard, one of the things that go ahead. One of the things that I've heard recently is that today, industry professionals, retailers, landlords, investors, lenders, restaurateurs, we have to not just think strategically, we have to think in terms of 3-dimensional, 4-dimensional, because every choice we make has multiple implications that impact value. And we may think, oh, this is the right thing to do today. But if we don't think it through in that long-term perspective, as Peter mentioned, we're setting ourselves up for failure because we've totally missed the ultimate objective.
Yeah, but you can't get paralyzed. So I'd like to move on and mention a couple of other things that relate to ongoing due diligence. And the first one of which, and I've had to deal with this on a number of occasions, is guarantees. And it's like nobody pays attention to this. But I'm going to talk about this in two respects. If someone is going to, you need to be able to do due diligence on the guarantor. I have almost never seen a requirement in a guarantee that requires the guarantor to provide financial data on a regular basis. And
I've seen it 5 times in my career. 5 times.
It's like never happens, except that when I've had to do collection work after the fact, it's like, okay, let me go ahead. I wanted to tell this story. Let's go ahead and let's see what we can collect from the guarantor. Because although Jeff talked about, I talk about collections, Jeff talks about payment, a lot of times I have to deal with this from the back end. And I look at the guarantor, and in one instance, I had a guarantor with all of his assets in China. and I had to go back and say, you know what, maybe we shouldn't worry about collecting this and et cetera, because I'm never going to be able to collect it. It's tough enough for me to collect if assets are in California. It's not that much more difficult to collect if it's in another state in the United States. I think I can even collect assets in Canada. All right, but if I have to go to China to collect assets, it better be worth tens of millions of dollars because we're not going to go through that effort. Jeff, what is your What does Federal Realty do with regard to ongoing due diligence on the guarantees?
It's tricky. I've seen it very few times in my career as well. Usually, if we're getting a guarantor, it's the individuals who are signing on a lease, and we've already done our due diligence on them, and they're putting their business in an LLC. So it's usually very, very closely related that we're kind of getting the same person. If we're getting into, like, we had a situation with a company based out of China, and they wanted to give us a guarantee. And we pivoted, instead of a guarantee, we pivoted to a letter of credit in the United States. Mm-hmm. The personal guarantees, what we find with the personal guarantees or just guarantees in general is if it's not very, very closely related to who we've got on the lease, such that the business flows right through to that person. So if we're seeing the business financials on an ongoing basis, we have a good understanding of their individual finances. We're usually not using a guarantee. We're getting into letters of credit more than anything else. And that feels a little bit more comfortable. And I'll tell you, I think for landlords, it offers a little bit better situation of you can take the letter of credit and draw down on it when there's a default. It's sort of take the letter of credit and ask questions later, or as opposed to the personal guarantees. If they're closely related to the business and the business is failing, the chances are you're not collecting on your personal guarantee either.
The letter of credit also likely protects you in the event of the tenant's bankruptcy.
Sure.
So there are advantages of doing that. Peter, the use of estoppel certificates, and again, this is, I see it maybe 30-40% of the time, requiring the tenant to provide an estoppel certificate. Even in instances when there is not a new loan in the process. What's your perspective on that?
Well, unfortunately, 99.9% of the time when I see an estoppel, it's due to a transaction of the property or refinancing of the property. Landlords are not using estoppels to check in with the tenant as they should. The other thing that I would mention about an estoppel, though, is with that estoppel, I always, and I don't see this, and I don't know if there's a reason why I don't see it from a legal standpoint, but I think that an estoppel, if you have a guarantee, you got to get the estoppel from the guarantor as well. And I just don't see that. So many times it just rests at the tenant level, and I want to see it on the guarantor as well. So should you be using an estoppel from time to time? I think so. I think it's a good backstop, but it freaks tenants out when they get an estoppel.
Mm-hmm. I see just the opposite. I've seen most tenants signing an estoppel without really paying attention to it.
Oh, I see that all the time.
Extraordinarily dangerous. Talk about amending a lease. If you don't pay attention to that, that's highly dangerous. And I've seen it quite a few times on the sale of properties where there's an estoppel certificate submitted to the tenant, and the buyer is actually leveraging to try to change the terms of the leases that better satisfy their financial perspectives on that.
I should point out that the risk involved with estoppels, though, is jurisdictionally sensitive. In some jurisdictions, the lease will still take precedence over an estoppel, but for an example, an option, you can't necessarily lose an option in some jurisdictions if the lease says there is an option. And I'm thinking specifically of Canada versus the U.S.
Sure.
I had something that I wanted to mention on in terms of, again, managing risk at the property level, at the store level, and with what's occurred with the financial pressures with stores in a survival mode, and that is the need for, which is something that's done maybe a little more casually than it should, but that's in monitoring and getting current certificates of insurance. That's something that we're seeing is a tremendous exposure that needs to be really tightened down by the part of landlords back to the lease administration function. But maybe Jeff's got some thoughts on that too.
Yeah, I mean, you got to make sure, again, it's managing the entire document. So it's ongoing due diligence. You want to make sure that they're living by all terms of the lease and not cutting short on other requirements that are going to be important to you as a landlord. So, we have lease administration all over that on a regular basis.
Yeah. That's one of the biggest mistakes I see property managers make, is not following up on the certificates of insurance. Let me just add one additional thing. I did a radio show maybe 5 years ago and had a number of insurance experts on, and they had all indicated that a certificate of insurance is usually by itself not adequate to give the requisite protection to the landlord, that the landlord should read the insurance policy. Now, I will tell you, if I fell asleep reading a lease, it'd take me 30 seconds to fall asleep reading an insurance policy. So,
Howard,
that's a difficult issue. Go ahead.
I was going to dovetail into what you said, and I'm glad you brought that up. When it comes to certificates of insurance, I used to have a huge portfolio that I took care of when I was the CEO of a REIT. And so many times the property manager would receive the certificate and put it in the file, not read it, and let alone a policy. Okay. And if you're going to fall asleep on a policy, they are so complicated. I can get two insurance people together and they're going to read two different things into the same policy. So, it goes back to something that I teach in a course that I do on transactional due diligence when you're purchasing or selling a commercial property. And that is, the due diligence is historic. Duty of care or due care is the question is, what does it mean? And then you have the underwriting. What are you going to do with it? The problem with the certificate of insurance is most property managers and lease administrators are not trained to actually understand what they're reading. So you should have an insurance expert on staff. If you're a Federal Realty, for an example, you probably have the ability to do that. But if you're a mom and pop, send it to your insurance company and say, does this satisfy the lease? Make sure that they have a copy of the lease as well.
And make sure they have malpractice insurance, because if they and they send it to you in writing saying, yes, you're covered, and then all of a sudden when you find out that you're not covered, then you can go after them. That's common sense business to me. I'm sorry. All right, so we're at 1 hour and 17 minutes. So I'm going to kind of wrap this up. I want to mention again that I'm doing a Deep Dish at 1:30 p.m., which is Rin Longmaid's stream. On February 4th, I'm doing a CRE TV live with Peter Jonathan Schultz, who's the CEO of Onyx Equities, Shlomo Chop, managing partner at Case Equity Partners, and Jody Yadev, analysis at TREP. Shlomo and Jody will be giving us the current status of the CMBS market. And Jody's been on our show before. Shlomo's going to be talking a lot about renegotiating on CMBS loans. Tomorrow I'll be doing an interview with Brad Umansky, president of Progressive Real Estate Partners, based in the Inland Empire in Southern California, and current president of the Retail Brokers Network. The interview should air next week on February 5th. I will be live streaming a short interview with Adam Dearmont regarding commercial financial issues in Southern California. And on February 18th, I'm really excited about this, I will be continuing my Icons of Real Estate series, interviewing Albert Baritz, the highly successful CEO of McKinley Company based out of Michigan. Now, one final question, gentlemen. What is the one most important point that the audience should take away from this webinar? Ken, why don't we start with you?
Well, thanks, Howard, for, again, hosting us today. I would say that the one important thing is the partnership between the parties. And in fact, if I'm able to expand on that, beyond that one thing, there's some things that really has been learned during the last 10, 12 months of pre and post COVID, and now that we're continuing to go into COVID, call it some lessons learned, if I may share that with everyone. And it really is, the partnership between the parties is critical. We've talked about the short, intermediate, and long-term thinking and multidimensional. the reason and the need to share data in a more open way. That open communication is critical to build trust. There's a common ground between the parties. It must be win-win or it's not sustainable. The lease covenants we absolutely are seeing as they're evolving. We know restaurants are going to survive, not all, but there will be many, many survivors and new concepts created. And integrity, attitude, and commitment are still the pillars of our business. If we can believe and trust each other, we have an opportunity for a successful and bright future. Thank you.
Jeff, what's the one most important point that someone should take away from this?
Other than you should hire Ken, I would tell you that
we're all sitting here going,
well,
oh, Ken, I need you.
Yeah. Howard, you should hire Howard, but if you've hired Howard, it's already gone horribly wrong. So
in most cases, yes.
I would tell you that it's critical thinking in the interim and the long term. It's not asking yourself what you can do, it's asking yourself what you should do. And then to Peter's point earlier, it's thinking down the road and not being so short-sighted as I have a problem, the tenant has a problem or a landlord has a problem today, I need to solve it today, but really looking at these documents, because the one key word that's been used a number of times here is evolution. Brands have to evolve, landlords have to evolve, and properties are going to have to evolve. And if we're really talking about COVID as this marker in time and there's a post-COVID reality, the lease was almost certainly negotiated pre-COVID. It has to address the post-COVID realities of retail real estate, which is there's going to be less, it's going to be different, there are going to be different uses, different rent dynamics, different tenancies, different everything. And so it's having that critical thinking to really step back and say, here's the problem I'm really trying to solve.
That's a great answer. Peter.
Well, Ken and Jeff have done a marvelous job of summing everything up that we've talked about over the course of today. I'll add just one other thing. We didn't actually address it, I don't think, but it is inherent in everything that everybody said today. And that is the business is evolving and changing. And you're going to need the data and you're going to have that critical thinking. So how do you do all of that? What wraps that all up together? Continue to learn, educate yourself, do your research. Don't think of, well, we've always done it this way, because that doesn't work anymore. It's not going to work today. It's not going to work tomorrow. Educate yourself. Continue to join Howard on his webinars, or Ken if he's doing something, or Jeff if he's doing something, and read and read and read and learn and learn and learn, because the dynamics are changing rapidly. We're seeing that acceleration. So educate yourself.
Yeah, Peter, I got to tell you, I am the senior person here. I'm 69 going on 70. And the ability to continue to learn is what gets my engine going and keeps it going. Because it just, at my age, we had this false idea that once you hit 70, that's it, you stop learning. But for me, it is so exciting to learn. Being on a webinar like this, people get the impression that, well, Howard knows it all. Let me get it straight to you. I'm sitting here learning from every time I have Peter on, I'm learning from Peter. Jeff has made some great points and straightened my head out on a number of issues. And so has Ken. This has been a learning process. So for me, the one most important element is do your due diligence and don't play games. Make sure that you know what you're getting into. And that includes when you're renegotiating. Let me just add one more thing. On the live stream that I'm doing later today, I'm going to be talking about what tenants can do, what restaurants can do. And one of the things I'm going to stress is be proactive on your documentation. If you want the landlord, and this is for tenants, and I know that the landlords appreciate this. If you want a rent concession, you need to not wait for the landlord to ask you for your documentation. Make it as easy as possible. on the landlord to be able to give you as much as you can get. And be proactive about it. Don't play games. Be transparent. You know, if you're asking for it and you're really doing fine, your business is 120% of what it had been, well, then maybe you shouldn't be asking for it. But if you've, like many, many retailers out there, if your business has been hurting, show it and have good records. And if you don't have good records, get someone like Ken to make sure you have good records. And that's it. That's my closing statement. Gentlemen, you were great. I lost total track of the outline. But I think we covered some really good information. So thank you very much. Let's stay in touch. Jeff, thank you very much. And Ken, thank you. And Peter, as usual, thank you very much. If you want to get a hold of us, that information has been sitting up on the screen for the whole time. Stay safe.
Thanks, everyone.
Thank you. Take care.
Bye-bye.
Bye now.
God bless. Bye-bye.